So let's move on to the next paper. The paper's title is Climate Change Concerns and Mortgage Lending. And the presenter of the paper is Tinghua Duan from IESEG School of Management. So you have 30 minutes.
Okay, thank you. Thank you very much. Okay, first, many thanks for the conference committee include our paper in ABFER conference. And I'm Tinghua Duan from IESEG School of Management in Paris. And this paper is titled Climate Change Concerns and Mortgage Lending, which is joint work with Frank Weikai from SMU. And all the comments are very welcome. Okay, first, according to this figure, we can observe the global temperature anomaly, and we can see the global temperature has been rising since the 1970s. Along with rising temperature is sea level rise, more frequent natural disasters, and extreme weather events. So many scholars and policymakers have warned of the potential damages to the global economy caused by the climate change. Recent studies explore whether financial markets efficiently price the long-run risk of climate change. Studying this research question is important because, first, pricing climate risks properly today reduces the possibilities of wealth transfers between uninformed and sophisticated investors. And second, it also reduces the likelihood of extreme price movements in the future. Policymakers also increasingly concerned about the systematic risk imposed by the climate change in financial stabilities. One approach to address the issue is to increase the amount of reliable information on financial institutions exposed to climate-related risks. For example, the Task Force on Climate-Related Financial Disclosures was created in 2015 by the Financial Stability Board to develop consistent climate risk financial risk disclosure for use of companies, banks, and investors for in providing information to stakeholders. However, financial institutions also need to be aware of climate change in order to take actions. So in this paper, we will examine whether lenders consider climate risks when originating mortgages in the US. Several features of the residential mortgage market make it relevant to study the impact of climate risk on financial market. First, the mortgages are characterized by real estates which are vulnerable to climate-related risks, including sea level rises, wildfires, and storms. According to the literature, Bernstein, Bodov, and their co-authors find that the sea level rise risk has been priced in the housing market. Second, most mortgages in the US have maturities as long as 30 years, a horizon over which climate risks may be well materialized. In our sample, there are more than 79% mortgages are longer than 20 years. While firms can adapt to climate change through geographic relocation and product diversification, adaptation for the real estate is difficult. Here, one may argue that the climate risks are mostly borne by insurance companies because mortgage applicants are required to buy flood insurance if the property is located in the special flood hazard area. However, various reasons suggest that in reality, mortgage lenders may still be exposed to the climate risk. First, both the number of flood insurance policies and their total dollar amount have declined substantially since 2006. Second, policyholders may not maintain their flood insurance over time as a median tenure was only 2 to 4 years. And the fourth reason of why mortgage lending is mortgage applications are subject to discretionary approval by local loan officers whose belief about climate change may affect their lending decision. Corti, Duchin, and Saussure 2016 GFE paper find that the positive sentiment of local loan officers. Finally, mortgage is the largest component of household debt, and has historically related to the systematic risks. In addition to academic, practitioners also pay more attention to the potential impact of climate risk on mortgage market, including Freddie Mac and the CEO of BlackRock. For example, Freddie Mac mentioned that it is less likely that borrowers will continue to make mortgage payments if their homes are literally underwater. As a result, lenders, servicers, and mortgage insurance are likely to suffer large losses. So to optionalize our research idea, we need a proxy that correlates with public belief about climate change over time and across regions. So follow a large literature in the climate science, we use the local abnormal temperatures as a proxy for public beliefs about climate change. The idea is that although local weather fluctuations may not be scientifically informative about the global warming trend, public beliefs about climate change should significantly increase after people are personally experiencing warm weather. An additional advantage of the proxy is temperature shocks are placebo exogenous to economy and helps making causal inference. So we first verify that high local temperature leads to elevated attention to global warming and the beliefs about climate change. To measure the attention to global warming, we use the Google SVI of the topic global warming. The Google SVI has been widely used in the literature to measure the people's attention. And second, we use the EU climate opinion maps data to measure the belief about climate change. The EU climate opinion maps is a survey data shows the fraction of US adults' belief about climate change at county level. Next, we find that high local temperatures also lead to significant reduction in mortgage origination, which is measured by loan approval rate and loan amount. When we break down the temperature anomaly into 5 quintiles and test the impact of origination on quintile of temperature anomaly, we plot the coefficient of the regression analysis in the figure and find a county in its warmest year has a 0.9% and 8.76% lower approval rate and loan amount compared to its coldest years. So in this study, our main challenge is to disentangle the credit demand and supply channel because abnormal temperatures could affect mortgage originations through both channels. On the demand side, the worsening local economic conditions due to higher temperatures drive firms or residents to relocate, which suppress the demand of mortgage credit. Our research design helps to disentangle both channels, and we find our result is not fully driven by changing local economic conditions and the demand for mortgage credit. To do so, we first include for state-by-year fixed effect, which controls the time-varying local economic conditions at state level, which may influence the demand of mortgage credit. And we also include the county fixed effect to control the time-invariant county economic factors. In addition, we control the county-level macroeconomic variables and the borrower characteristics. Thirdly, our results hold in counties with strong demand for mortgage credit, which is measured by the above median for the number of total applicants and for the total loan amount. And finally, we also conduct a placebo test using fintech lenders, and I will provide more details about the test later. So the underlying mechanism of our paper is a belief channel that lenders' rising concerns about climate change affect their lending decisions. And we find that the negative effect is stronger in counties with strong prior belief about climate change. after public become more aware of climate change and in counties more exposed to sea level rise risk. So our paper makes several contributions to the literature. First, we contribute to the understanding of economic impacts of climate change. One implication of our study is that climate change may also adversely affect the local economy through reducing the supply of mortgage credit in regions most vulnerable to climate risks. Second, we add to the new climate finance literature that concerns whether financial markets efficiently price climate risks. The evidence in our paper suggests that lenders do account for climate change risks when originating mortgages, but only when they sufficiently believe in climate change. Third, our paper also related to prior works on how local weather fluctuation influence public beliefs about climate change. And we show that agents' hidden concerns about climate change affect their real decision making. And so far, hope you could have an overall picture about our study, and I will talk more details about the paper. To conduct this study, we obtained the data from NOAA about the county level monthly temperature, and we constructed the temperature anomaly, which is defined as the difference between the 36 months moving average temperature and the 30 years historical average. We obtained the mortgage application data from HOMDA database, which provide all mortgage applications reviewed by qualified financial institutions. And the database contains borrowers' characteristics, loan characteristics, and decision on loan applications. And finally, we obtained the 83,000 county year observations for 3,100 unique counties from 1990 to 2016. We also obtained the loan interest rate data and characteristics from Fannie Mae and Freddie Mac loan level dataset. And the data is in zip code year level. And we obtained the county level macroeconomic variables and from Census Bureau and the Bureau of Labor Statistics. The housing price index data is obtained from Federal Housing Finance Agency. So here is the summary statistics of our sample. According to this table, we can see the average loan approval rate is around 70%, which is consistent with the literature. And we constructed two main measures to proxy the loan origination. The first one is loan approval rate, which is the number of loan applications approved by divided by the number of loan applications reviewed in a county year. And the second measure is the loan amount, which is a total dollar amount of originated loans that are not sold to other institutions in the end of the year in each county year. So before our main test, we want to first test the persistence of local temperature anomaly. The key assumption of our paper is local temperature anomalies are idiosyncratic and unlikely to be informative about global warming trend. So if that is the case, we should not observe the persistence of temperature anomaly. So we regress the temperature anomaly, the 36 months moving average temperature anomaly on its own leg. And we find the insignificance of temperature anomaly, which confirm our key assumption that the local temperature anomaly is unlikely to be informative about global warming trend. So for the main empirical test, we first verify that the local temperature shocks are valid proxy for public beliefs about climate change. We use two measures to measure the attention and belief in climate change. The first is the Google SVI of the topic on global warming in each DMA level. The sample period is from 2004 to 2016. And here is the result. We find that the temperature anomaly is positive and significantly impact on the abnormal SVI. When we break down the temperature anomaly into 5 quintiles, we find that our result is driven by the warmest quintile. And this test confirm that the temperature anomaly is a valid proxy for attention to global warming. Then we also verify that the temperature anomaly is a valid proxy for climate change belief. We obtain the climate change belief data at county level from EU climate opinion maps. And we construct 2 measures to proxy for the climate change belief. The first is worry, which is defined as the fraction of population in county who are somewhat or very worried about global warming. And the second measure is the timing, which is a fraction of population in county who think global warming is already harming people in the US now or within the next 10 years. The sample period covers from 2014 to 2018. Here is the table shows the result. We regress the worry and the timing on temperature anomalies respectively, and we find the coefficient of temperature anomaly is positive and significant on worry and timing, which confirm that the temperature anomaly is a valid proxy of public belief about climate change. So after verifying the proxy, the next question is, does the effect of abnormally high temperature extend beyond climate change attention and belief to affect agents' real decision making? So to answer the research question, we developed the non-hypothesis as local temperature fluctuation will not affect mortgage origination when lenders think climate risks are irrelevant for mortgage loans, or they do not connect the higher local temperature to a large narrative of climate change. On the other hand, lenders become more concerned about the climate change and its potential impact on local housing market after experiencing abnormally high temperature. So our specific prediction is lenders will reduce credit exposure to regions vulnerable to climate change risks through approving fewer mortgage applications, originating lower amount of loans, or charging higher interest rates. So to test our hypothesis, our empirical methodology closely follows the climate economy literature and rely on exogenous weather variation over time within a given spatial unit as identification. So here is our specification to test our hypothesis. Our independent variable is loan approval rate or total loan amount in county I for state S at year T. And the independent variable is temperature anomaly is a 36-month moving average temperature anomaly in county I of state X at year T-1. We also include the county fixed effect, state by year fixed effect, as well as borrower's characteristics and the county level macro variables. When the dependent variable is loan interest rate, the I indicates the zip code. So here is our baseline result. In this table, we find the temperature anomaly has negative impact on the loan approval rate. And when we break down the temperature anomaly into 5 quintiles, and we find the result is driven by the warmest quintile. The findings confirm our prediction that lenders' perception about climate change reduce the loan approval rate. So to further investigate, to further shed light on the channel, we investigate the loan denial reasons for rejecting loans. The HOMDA database provide the loan denial reasons for each rejecting loans. And if lenders are concerned about climate risks and its adverse impact on underlying collateral, we expect the lower loan approval rate mainly due to the collateral reason. So we construct the loan denials for collateral reason, which is the number of loan denial for collateral reason divided by the loan denials for all rejecting loans in a county year level. Then we regress the loan denials for collateral reason on temperature anomaly using the same specification as our baseline test. We find that the coefficient of temperature anomaly is positive and significant on loan denials for collateral reason. So these findings confirm that the lower loan approval rate mainly due to the collateral reason and further confirm the lender's belief channel. Next, we also use another measure, loan amount, to measure the loan origination. And we rerun our baseline test using the loan amount as dependent variable and find the coefficient of temperature anomaly is negative and significant, which is consistent with our loan approval result. Finally, we test the impact of temperature anomaly on the loan interest rate. And the coefficient here is insignificant for the temperature anomaly, which is consistent with the literature that loan pricing is driven mainly by the computerized algorithms that rely on hard information with relatively little input from loan officers. It is also consistent with the credit rational model in a market with adverse selection. So in addition, we also conduct a battery of robustness tests about our baseline result. We find that the negative effects of temperature anomaly on mortgage lending is robust when we control for county-level housing price index, which is intended to control the demand of residential mortgage application. And it is also robust when we remove the subprime mortgage crisis period and control for the damages caused by a natural hazard at county year level. Our result is also robust when we exclude 5 states that are largely influenced by the flooding risk. So as I mentioned earlier, the major challenge of this study is to disentangle the credit demand and the supply channel, because climate economy literature shows that higher temperatures negatively affect labor productivity, industrial and agricultural output, and economic growth. So the worsening local economic conditions could drive firms to relocate and residents to migrate to less affected regions. It also reduces the local employment opportunities and the income, and finally shrinks the tax base of local governments and its ability to maintain infrastructure and public service. And consistent with the demand channel, we find that counties experiencing higher temperature have lower quality of application pools. So to control for these characteristics of mortgage applications, we include all these borrowers' characteristics in our baseline test. In addition, we further account for the demand channel using 2 robustness tests. We first conduct a subsample test for counties that have experienced a strong demand growth for mortgage credit, which is measured by the above median for the total number of applicants and the total loan amount in county level. And in addition, we also conduct the placebo test using the fintech lenders. So for fintech lenders, the application and the review process for mortgages are almost entirely conducted online, and no human loan officers are involved in the decision-making process. As a result, if temperature anomalies affect mortgage lendings through its effect on local loan officers' climate change belief, we should find no effect for loans originated by fintech lenders. On the other hand, if the effect we document is due to unobservable reduction in demand for mortgage in areas with abnormally high temperature, we should find a similar negative effects for fintech lenders. So following the literature, we identify 7 fintech lenders to conduct the test. So here is a figure plots our regression, the coefficients of regression analysis. And the positive effect of temperature anomaly on fintech lenders is inconsistent with demand channel, but consistent with the Foster's 2019 paper shows that fintech lenders partially fill the credit gap left by traditional lenders because they can adjust the supply more elastically. The underlying mechanism of our paper is that lenders' perception about climate change increase significantly after the experiencing usually warm weather and take actions to reduce lending to the local housing market. So consistent with the belief updating mechanism, we further find the effect of temperature anomaly on mortgage origination is stronger in counties that hold strong prior belief about climate change. And it is more pronounced among counties heavily exposed to the risk of sea level risk. It is more pronounced in periods with more intense media coverage on climate change related topics. And we also conduct the placebo test using the precipitation anomalies and find the precipitation anomaly is not a valid proxy for public belief about climate change. Due to the time constraints, I will not present the details of these results. And in addition, our mechanism also predicts the effect is stronger when agents are able to connect higher local temperature to a large narrative of climate change. So we rely on a quasi-nature experiment surrounding the release of Stern Review in October 2016 to conduct a diff-in-diff test. The Stern Review is one of the earliest and the most well-known analysis of the economics of climate change and likely significantly raised public awareness of climate change. However, Stern Review is unlikely to change the physical risk of climate change. In addition, a documentary film, An Inconvenient Truth, also released around the same time, which may also help raise the public awareness of climate change. So here is a Google SVI for climate change around the Stern Review and Inconvenient Truth release date. We could obviously find that after the release date of both events, the attention to global warming substantially increased comparing to the pre-release date. When we look into the specific topics that related to the searching item for climate change, we find that topic lists to increase the Google SVI are all related to climate change. And here is the figure plot of the diff-in-diff coefficients of temperature anomaly on loan approval and the loan amount in 2 years before and 2 years after the Stern Review was released in 2006. And we can clearly observe a downward trend for the coefficient of negative impact for temperature anomaly after the 2006. So finally, let me conclude this paper. Using the mortgage origination as a laboratory, we test whether agents' heightened belief about climate change affect their real decision making. We find a strong negative effect of abnormally high local temperature on mortgage origination in the US counties. We also find the effect does not seem to be fully explained by changing local economic conditions and the demand for mortgage credit. And finally, we find the effect is stronger among counties with strong belief in climate change, most exposed to risk of sea level rise and during period of heightened media tensions. And the evidence of our paper led to an important policy discussion that will the predicted rising temperatures and extreme weather events lead the society to reassess climate change risks and invest more resources in mitigation and adaptation. That's my presentation. Thank you.
Thank you very much, Tinghua. The discussant is Zoe Yang from Chinese University of Hong Kong. Zoe, the floor is yours for 10 minutes.
Okay. Well, I want to thank the committee for giving me the opportunity to discuss this very interesting paper. And I want to thank Tinghua for the great presentation. I really enjoy reading this paper. So given that we are in the area of climate change and financial market can price the associated climate change risk, this paper raises a very important question. So whether beliefs about climate change affect loan officers' mortgage lending decision. And to answer this question, the study uses a proxy, the local temperature variation, which correlates with public belief about climate change over time and across regions, and also possibly exogenous to local economic conditions. And basically, they study whether temperature anomaly affect climate change belief and then agents' decision making. And use monthly county level temperature data and mortgage application data from 1990 to 2016. And they test the hypothesis that the mortgage lenders who experience abnormally high temperatures are more concerned about climate change and its negative impact on local housing market. So the study finds that in abnormally warm weather, local loan officer approve lower mortgage applications and originate lower amounts of loan. And they also find a lower approval is mainly due to the collateral reason, but not other reasons. So the authors conduct a battery of robustness checks and address many alternative explanations. I especially like the fintech analysis and because it helps us to better understand the underlying mechanism. And after reading this paper, I have mainly 3 sets of the comments, and I will elaborate on them in detail. And my first comment is related to the risk perception of sea level rise, as the study placed a heavy emphasis on that. It's not clear to me to what extent the abnormal temperature affects the sea level rise, and to what extent sea level rise affect lenders' risk perception of climate change. So in other words, to what extent do lenders care about sea level rise? And how can Google search accurately reflect lenders' perception on sea level rise risks? So I think it would be great if the paper can provide more evidence just to show the linkage and maybe show us how frequent this kind of disasters caused by sea level rise took place in the last decades. So the sea level rise is a slow and continuous process as compared to other nature disasters that more frequently happen, such as floods, hurricanes, windstorm, or wildfires. So for example, the research showed that they forecast that the sea level rise will rise about to 31 inches by 2060 in Florida and will affect around 120,000 properties, but since it's a gradual process, so people got time to deal with it, and people have collaborated and taken possible solutions to tackle this issue, such as elevating roads, building seawalls, installing new and higher capacity pumps in drainage system. So it's a little bit puzzling to me, how do we connect the perception on sea level rise to lenders' decision-making process? And as I've mentioned, compared to sea level rise, flooding episodes were becoming more prevalent and would affect property values more likely. So in this case, households can choose to purchase home insurance to protect themselves from the climate losses, and regulators also require homeowners to purchase insurance in area that exposed to this kind of climate risk. And we can argue that the climate change risks are priced into insurance premium, and the sea level rise risks are borne by the insurance company. So the authors has already addressed this concern. So they exclude 5 states that are more likely to be affected by floods, so including California, Florida, Louisiana, New Jersey, and Texas. And they still find a significant and negative effect in the subsample. So it's a little difficult for me to understand why there's a negative effect of temperature anomalies on mortgage originations for property with a lower risk of being flooded. So if the climate risk affect lenders' decision, then I would expect to see insignificant impact in the subsample. And so the significant and negative effect in the subsample analysis could suggest alternative channels that may affect lenders' decision. So in addition to the risk perception documented in this paper, I was wondering whether there's another channel that's explain these findings, which is the mood effect. So studies in psychology and behavior economics have shown that higher temperature affects mood. So studies have shown that hotter weather was associated with a lower mood in the summer, and or a positive relationship between the sentiment and the loan approval rate, etc. So the alternative explanation could be that the abnormal temperature affect lenders' mood rather than their climate change belief, then consequently affect their decision, then they deny more loans during the hotter period. So there are some suggestions I have just to look into the variation of mortgages with homeowners insurance. So especially that you can focus on properties with a flood insurance. So just to make best advantage of the home data, I was wondering whether you can use the micro level data directly rather than the aggregating it into the county level. So if you have a micro level data, you can just compare properties with flood insurance to those without. So properties with flood insurance should not affect lenders' decision. And if you only have the county level data, then you can probably just to narrow down your sample to the counties with mandatory insurance scheme and see if you can still see negative impact on temperature on mortgage origination. So another point is that both the borrower side and lender side could affect mortgage origination, and controlling for characteristics of loan officer is important because mortgage decisions could be subjective. So for instance, what if loan officers move from one city to another? So I think you can control for loan officer fixed effect if you have access to the micro level data, and otherwise you should show that the average characteristics of loan officers remain the same during the sample period. And another concern is related to the argument about the collateral reason. So when the study look into the reasons for loan denials, they find that lower approval rate is mainly due to the collateral reason. So here I think it's important to distinguish between low quality assets and regular assets with climate change risk, so that you can probably then you can pin down this the reason. So maybe you can control for assessment value or do some other test. And another comment is about the DID analysis. So I will more likely to call it an event study because it's difficult to convince people that stern review only affect a certain group of lenders or certain group of properties. So I was also wondering whether it's appropriate just to use the 2007 to 2009 as a post period, because it's also the post period of the subprime mortgage crisis. So this may contaminate the results, and the study should eliminate other confounding factors in this period. And another suggestion is to include county fixed effect in table 2 when you examine the relationship between the temperature anomaly and public attention, because there are many unobservable factors could affect the public attention to climate change at the county level, such as culture, education, or even the access to internet. And you have already control for the state year fixed effect, and I was thinking maybe you can do more robustness check just to replace the state year fixed effect with a county year fixed effect, just to rule out the potential shocks that take place at the county level across years. And I like the fintech analysis very much, but I expect to see more evidence that the clients of fintech lenders are similar to the conventional loan lenders. And So just to conclude, this is a very interesting research and it provides important real-world implications. And the authors have conducted very careful analysis with a battery of robustness checks. And it's a very nice paper and I've learned a lot from it. And thank you.
Thanks a lot, Zoe. Yes, so Tinghua, would you like to take a couple of minutes to respond to the discussion before we open the floor?
Yes. Okay, first, many thanks for Zoe's great discussion, and your discussion is very helpful to improve our paper, and we will incorporate your comments and suggestions in the next version. And I want to respond to a few points of your discussion. The first is about the using the measure of SVI about the lenders, about the loan officers' attention to global warming. According to our study, yes, it's hard for us to directly link the Google SVI to the local loan officers' belief about climate change. So in addition, we use the EU survey data as an additional proxy to link the public belief about climate change to the local loan officers. I think same as Mingzhu's paper, we also have the similar problem to identify the local loan officers' behavior, and which is in your in your next comments, and we cannot observe the individual loan officers' behavior, and because we have the data constraint on the micro level data. And in terms of your the comments about the about our test that excludes 5 states that are largely influenced by the flooding risk, and we exclude those states because we want to provide robust results that our result is not influenced by the flooding risk, because we want to prove that the mortgage lenders are exposed to the climate risk without considering the states with flooding risk. So the underlying channel is still the belief channel, because I can give you an example to better understand why we argue the belief channel. In recent years, more and more natural disasters are happened in some counties that have never experienced the natural disasters like storm or hurricanes. So we want to argue that after local law officers personally experience the unusually warm weather, their belief about climate change are updated. And finally, according to your minor comments on our table 2, and suggest us to include the county by year fixed effect. And unfortunately, we cannot include the county by year fixed effect because our unit of analysis is county year level. If we include the fixed effect, it will absorb all the variations of our data. That's all my response to your comments. Thank you.
Thank you. So I see one question in the Q&A from Woodpaul. So let me just read it out. If beliefs are updated in a Bayesian sense and a person has strong prior belief that climate change is occurring, then posteriors will not change much if temperatures rise. Shouldn't therefore the effect be weaker in counties with strong beliefs? Do you like to respond?
Yeah. First, thank you for Woodpaul's comments, and according to our paper, we argue that the Bayesian sense, the belief about climate change would be improved once people experience the unabnormal warm temperature, and I'm not sure why you think it's the effect would be weaker, and according to our argument, we predict it will be stronger. Yeah, maybe we could discuss more details later.
But it'll be hard for you to argue against Utpal's point. But let me make a different point.
Yeah.
If you really believe climate change is happening, then shouldn't the developers be the first ones to then react and cut down supply of housing? And as a result, that will change how the pricing and how the lender will behave. And so I feel there is a confounding effect. You're like saying this is all being driven through the banking channel, but it's being driven through actually the supply of housing. Those are the guys who should react, if anything. I mean, what I'm suggesting will still be applicable to Utpal's criticism, but still there should be some response by the developer.
Yeah, thank you, Shumi. Actually, in our robustness test, we control for the housing price index in our regression to control the supply of housing market.
Okay. Are there any more questions? Okay, I guess there are no further questions, and I think it will be natural to maybe have a break here. So according to the program, we'll have a 10-minute break. So we'll come back in now like 13 minutes at 4:50 Singapore time. Okay, so basically in 13 minutes. So I'll see you guys in a little bit. First of all, thank you a lot for the both presenters and discussant for the first two papers.
Thank you.